Right, let's get started. So I'm Katrina Attride. I'm a partner in the private client team at Mills & Reeve. Thank you for joining me this morning. I'd just like to say that if you've got any questions as we go along, please do type them in the Q&A box. There's quite a lot to cover, and I expect that we will be a bit tight on time. So if you leave your name with your questions, if I don't get to them this morning, I will reply directly later on. During this session, we're going to be exploring the opportunities available to business owners to maximise the benefit of business relief in relation to inheritance tax before they exit their business. As a lot of you might already be aware, business relief is a really generous provision, and it can be wasted where a business is sold before a death without any planning. The intended outcomes for this morning are to give an overview of the process of pre-sale business planning generally, to understand where estate planning fits into the pre-sale business planning cycle, consider how the sale of a business presents the owner with an opportunity to structure their legacy in a flexible and protective way, and to ensure that the valuable inheritance tax reliefs that are available are utilised to mitigate tax payable on death. Before we look at the estate planning side of things, we will take a few minutes to consider the wider context. I think the best place to start is, what do we actually mean by the term pre-sale planning? And the answer is actually quite a lot. I would suggest that it can be broken into two main categories. There's the pre-sale planning needed to get the business in shape and ready for a sale. And then there's the pre-sale personal estate planning that can be implemented to make sure that the proceeds of the sale are maximised from a tax perspective. Before we take a close look at the personal estate planning aspect, we'll briefly consider the first arm of pre-sale planning, which involves getting the business into shape. Successful planning and preparation ultimately leads to an owner achieving a sale of their business or a share in a business at the best price, in the smoothest way possible, hopefully, and whether that's to be by a sale to a third party or perhaps on an MBO. So let's consider what the process looks like. The decision to exit a business is very rarely an impulsive one, although there are a number of different drivers that lead to that point. In most cases, a sale is the culmination of what the business owners have been working towards for a number of years. And the process could start up to 36 months before an intended sale. And this is the sort of traditional aspect of pre-sale planning, where the business will look to get everything in order, ready for that sale. Although it's not an exhaustive list, this is likely to include making sure that there's a capable management team in place, ensuring good financial hygiene with up-to-date management accounts and forecasts, reviewing all legal and compliance issues, assigning an attributable value to the business, and reviewing all operational and commercial matters. The aim in looking at these areas is to reduce the risk of an aborted sale or a price reduction, and ultimately to give a time and hopefully cost saving on the eventual sale process. Although we don't look at this aspect in detail in this webinar, it is something that the team at Mills & Reeve can discuss with clients in more detail. The exit process itself is usually 4 to 6 months before the actual completion, and is when the business owners have agreed to the sale and are in the thick of getting it over the line. This is followed by the sale and the completion process. For the remainder of this session, we will consider where personal estate planning fits in and why it's important. Typically, the stages of a business owner can be illustrated by the following diagram. There's the early stage where the owner is likely to have few personal assets. The majority of their savings have likely been put into the business. The business could well be leveraged with a small current value, and their wealth is mainly in the future potential. As the years go by, we move into the established stage where the owners will hopefully be accumulating lifestyle assets due to the income that's been coming out of the business, perhaps still have little non-business investment, and the wealth is mainly still within the business. And then when we get to the exit stage, more often than not, you're going to find that people have much more substantial lifestyle assets accumulated. They are then going to have the proceeds that come out of the sale of the business. And they could also be in a situation where their expenditure in the future is likely to exceed their income. It is important to coordinate the sale of a company, though, with the broader estate planning. So typically, the business will be the owner's largest asset and will form the primary basis for their wealth plan. Failure to plan before a sale can undermine both the wealth creation that they have worked so hard towards and the preservation opportunities that could be afforded by the transaction. Coordinating the owner's pre-sale planning and estate planning can provide really quite significant benefits to them and their families. And this includes reducing inheritance tax payable on death, opportunities to gift to trust without inheritance tax becoming payable, and an increased chance of achieving familial and personal wealth succession goals. It's important to understand the owner's wealth philosophy, which might well be something that they haven't even thought much about themselves. So essentially, what is the money that they are about to realise for? It's crucial that even during the busy pre-sale process, where it's really difficult to think about anything other than the deal, that the end goal is clear and that plans are put in place to achieve that goal as early as possible. Factors to include that we look at are, are we dealing with a serial entrepreneur? Will they be using a significant portion of their proceeds to invest in another business? Are there any philanthropic objectives that they want to fulfill or explore further? And also, what are their lifestyle needs likely to be post-sale and perhaps moving into retirement? So having considered the owner's wealth philosophy and their broad financial objectives, we then need to give careful consideration to the individual circumstances so that we can determine how much the owner can afford to give away to satisfy their succession and philanthropic objectives. This is an exercise carried out usually with their wealth advisors and essentially acts as a personal wealth assessment. This diagram illustrates some of the main factors that make up an individual's personal balance sheet. So we're looking at any surplus income, sale from the business proceeds, net of taxes, and the accumulation of assets that they've had over the years. And this all feeds into their balance sheet. We then look at securing their lifestyle. So quite often this will involve cash flow planning. How much do they need to see them through retirement based on various different factors? Reviewing of potential sources of income, which might include pensions and or other investments. Sometimes we find that business owners have neglected pensions over the years. Other times they have a healthy provision. So where are we on that? We're then also looking at securing their asset base. So we're looking at the main home, holiday homes, cars and valuables, and then other high risk projects perhaps, or angel investing that there might be an appetite for if there's a big influx of money that's come out of an exit. And also I always say they should keep a fund money pot before we start thinking about any other planning. We then look at the excess capital and what we can do with that. So lifetime giftings, whether outright or to trusts, which is what we're going to look at further, family investment companies, philanthropy, and making sure provisions in wills are all appropriate and up to date. So once the owner is comfortable with the extent to which they need to benefit from the proceeds of the business sale, we can then focus on how best to make gifts as part of their planning, making the most of the opportunities that are available pre-sale. The primary aim usually is to maximise the likely benefit the owner of a trading business will have in the context of inheritance tax and business relief, BR. Pre-sale, the business interest is likely to have a nil value for inheritance tax as a result of business relief, which gives 100% relief to qualifying interests. Immediately following the sale and without any planning, the whole value of the net proceeds of sale are going to be fully chargeable to inheritance tax on death because business relief will no longer be available. So it's a really significant number in a lot of cases. There is scope to benefit from replacement property relief, where old business property, essentially, which qualified for business relief, has been sold and it's been replaced by new qualifying business property. Business relief is given on replacement property if the aggregated ownership periods total at least 2 of the 5 years immediately preceding the transfer. It cannot exceed the business relief that would have been available had the original asset been retained. And in reality, it's unusual to find individuals who want to reinvest a substantial portion of their sale proceeds back into another business relief qualifying asset, but it is a factor to consider. We then have the option of outright gift. So following the completion of the sale, the owner might consider giving away some of the net proceeds following what they've just been through. The simplest option is to make cash gifts, which would be potentially exempt transfers for inheritance tax. There's no limit to the value of outright gifts, and provided the donor of the gift survives 7 years, there would be no inheritance tax payable on death. However, there are disadvantages to making outright gifts to family in view of their current or future personal circumstances. There's no protection for the recipient of the gift in case of a relationship breakdown, and the full value moves from the balance sheet of the donor to that of the recipient for inheritance tax purposes. So you can find yourself kicking the can down the road a bit with inheritance tax. Furthermore, the donor has no say in how the funds gifted are utilised, which can be a concern. As an alternative to an outright gift to individuals, a gift from the sale proceeds to a trust can be made. So I should stress that neither the person creating the trust nor their spouse or civil partner can benefit from the money that is gifted to the trust. If they do benefit, there would be a reservation of benefit for inheritance tax purposes. The advantage of making a gift to trust is that it allows the donor to retain an element of control by being a trustee. The donor can decide when, how, and how much family members can benefit from. It provides a level of protection for the intended recipients in case of their own financial or personal issues that might arise with divorces or financial difficulties. And moreover, a trust is a really good vehicle for multi-generational estate and tax planning, particularly when we've got quite high values at stake. The trouble is, on the face of it, is that a gift to a lifetime settlement is a lifetime chargeable transfer for inheritance tax purposes rather than a PET, a potentially exempt transfer. And you're restricted to gifting the nil rate band, which is 325,000 or 650,000 for couples. If more than this amount is gifted into a trust in a 7-year period, the excess is subject to an immediate inheritance tax charge of 20%. This therefore limits the value that can be gifted without triggering a tax charge. But this does not apply to gifts of assets that qualify for business relief, such as an interest in a trading business. There's no limit in the amount of a business relief qualifying asset that can be gifted to a trust. This gives the business owner a really valuable opportunity to make a gift of shares to a trust before the sale, whilst there is no limit to the value that can be transferred to the trust. Following the sale, the value of the shares gifted will not sit on the owner's personal balance sheet as an asset and therefore will not be charged to the 40% inheritance tax rate on their death. And moreover, the money within that trust will be ring-fenced for family or whoever the beneficiaries are. Once a client is personally satisfied that the gift of a portion of his or her shares is the correct approach, consideration does need to be given to whether or not such a gift is even possible. We need to consider, are there rights of preemption that give other shareholders or parties a right of first refusal to purchase the shares on a disposal, because a gift to a trust would be usually considered as a disposal? Are there restrictions in the Articles of Shareholders Agreement as to the timing of transfers, or a restriction on who they can be transferred to? Do we need consent from one or more people? It really isn't uncommon to find some level of restriction in a business, particularly where there's more than one shareholder. And it's therefore really important to have the ability to make the proposed gift and make sure that we've assessed it early on, that we're actually able to do it. So often, whilst agreement is going to be needed, it will be forthcoming. It isn't always. So if we've got a bit of time to iron those things out, that's quite valuable. Once the client is clear that the gift is right for them and it will be possible to make the transfer of the shares, we then need to give detailed consideration of the inheritance tax and capital gains tax consequences of the gift. And we will first look at inheritance tax. So as I mentioned previously, any individual can make a gift of up to £325,000, being the nil rate band, to a relevant property trust in a 7-year period without incurring an immediate charge to IHT. Where an individual gifts more than that, there is an IHT charge of 20% on the value that exceeds the nil rate band. A relevant property trust for these purposes is either a discretionary trust or life interest trust created during lifetime. However, where the gift to trusts is of assets which qualify for either business relief or indeed agricultural property relief, there is no limit to the value that can be added to the trust, and there will be no IHT on entry. We are focusing on business relief in this webinar. Business relief eligible companies are often referred to as qualifying trading companies, but the statutory definition is framed in a negative way. The statute effectively provides that shareholdings in all companies are eligible for business relief unless the company's business consists wholly or mainly of dealing in shares and securities or land and buildings, or making or holding investments subject to an exception for qualifying holding companies. Business relief is determined on an all or nothing basis. The shareholding either qualifies in full, subject to the accepted assets exclusion, which I will come to, or it doesn't. It is therefore possible for a company's shares to fully qualify for 100% business relief, provided it's not mainly carrying out an investment business. This means it is mainly trading. A small or incidental investment activity run alongside a predominant trading one would effectively attract business relief through the value of the shareholding. The wholly or mainly test for business relief is generally taken as meaning more than 50%. So this differs from business asset disposal relief for CGT, where the trading level requirement is 80%. We'll look a bit at accepted assets. Business relief is reduced to the extent that the value of the shares reflects any accepted assets held by the company. This is an anti-avoidance provision seeking to prevent taxable personal assets from being sheltered from inheritance tax by being held within a business relief eligible company. This might include holiday villas and other private assets that are held within the company for the owner or manager's private use. The accepted assets restriction can also prevent business relief being given on excess cash reserves being built up within a company. So as an overview, an asset is treated as an accepted asset if it is not used wholly or mainly for business purposes in the previous 2 years, unless it's required for future use in the business. HMRC will generally seek to examine the accounts and other relevant documentation to establish whether the company's assets were being used by the business at the time of a death or chargeable transfer. Many companies have retained increased cash balances to act as a buffer against future downturn in their trade. Sometimes they're required to hold cash in order to secure certain contracts. There is an argument that these amounts should be considered as being legitimately held for business purposes. A note should always be made in board minutes addressing this point if you are carrying quite a lot of cash. But HMRC have confirmed that unless there's evidence showing that the cash is being held for an identifiable future process, it's likely to be treated as an accepted asset for business relief purposes. They've stated that holding surplus cash to buffer, as they say, economic difficulties is not sufficient reason to prevent funds from being treated as an accepted asset. Case law that we have available on this area suggests that the cash needed by a company as working capital would be up to 25% of its turnover. Cash balances of less than this are unlikely to be argued. This is a common pitfall for businesses. It doesn't result in relief being lost altogether, but rather that the value of the accepted asset would not qualify for relief. Often shares to be gifted are in a holding company. The purpose of a holding company is to hold shares in the various subsidiaries and to act as a conduit through which to distribute dividends to the shareholders. Aside from these functions, the holding company doesn't actually usually have any activity and is not in itself trading. At first sight, this would seem to exclude any possibility of business relief since the holding company has no trade. However, the legislation does allow relief where shares in a genuine holding company, which does not have any an investment business, can qualify. A further challenge arises where a business is structured to have its trading business in one subsidiary and non-trading assets, such as property, perhaps in a separate subsidiary. The provisions in the legislation allow relief where land or buildings used in the trading subsidiary are held in an investment subsidiary, but this is something that you need to be reviewing. Assuming 100% business relief is expected, and we can advise on this if instructed, there is no limit to the value that can be gifted by way of chargeable transfer, provided that the shares have been held for the qualifying period. There are clawback rules which broadly treat the gifted shares as being a gift of cash if the donee, i.e. the trustees, sell the shares and the donor then dies within 7 years of the original gift and no replacement property is held, which is often what's happened with particularly pre-sale planning, but it's a bit of a nothing ventured, nothing gained approach, or no worse off in that situation. A planning point, when we're advising clients, even before they're contemplating a sale, we should be encouraging them to carry out a review as to whether they will actually qualify for business relief. Many assume that they will and then fall foul of the wholly or mainly test or the accepted asset points. The point the shares are treated as being sold is the point at which there is a binding contract for sale in place. The legislation denies business relief to any asset subject to a binding contract, and therefore timing of the gift to the trust is key. Provided the gift is made before the sale becomes binding, the immediate IHT charge on the gift to the trust will be avoided. If the client hasn't made any other chargeable transfers in the last 7 years, they might also decide to make a gift of cash up to the nil rate band in addition. This could be done post-sale, and particularly if we think that there might be an argument over accepted assets, it might be that we want to keep the nil rate band intact to catch some of the value that might not be covered by relief. Turning to capital gains tax, a transfer of shares to a trust is a disposal for capital gains tax purposes. The date of the disposal for capital gains tax is determined as being when there is a beneficial ownership change, not when the legal ownership passes to the acquirer. In the case of a gift, the disposal date is when the donor has done everything necessary for the beneficial ownership to pass to the donee. On a gift into a trust, the donor can elect to either crystallise the gain and pay tax or claim holdover relief under Section 260 of the TGCA. This relief applies to gifts that are chargeable to IHT. So even though there's no IHT payable on the gift of the business relief qualifying asset, it's still treated as chargeable to IHT, and therefore gifts into a lifetime discretionary trust benefit. The donor and the trustees must elect to claim the relief, and the result is that the trustees acquire the assets at the donor's base cost. The CGT is therefore being deferred until there is an actual disposal and the trustees have the sale proceeds to pay the tax. The relief can also be claimed on the way out of the trust to a beneficiary, and therefore a beneficiary could receive share assets outright at the original base cost of the owner without having triggered any CGT. Before a decision is taken about whether or not to hold over the gain on the gift of shares, consideration does need to be given to business asset disposal relief, which was a replacement for entrepreneurs relief, which came in March 2020. The business asset disposal lifetime limit is only £1 million, which previously with entrepreneurs relief it was 10 million. So it's not such a consideration as it used to be. CGT is charged at a flat rate of 10% if that relief applies. In the majority of cases, the lifetime limit will have already been used, but if there is any remaining, then it can be utilised on the sale of any shares the owner is retaining and not gifting to trust. Alternatively, the owner might choose to pay the CGT on part of the gift to utilise the relief and hold over the remainder. So there is a summary of options on the CGT side. We can make the gift to the trust and claim Section 260 holdover relief, which is most common in all honesty. We can make the gift to the trust with no claim for holdover relief and trigger the gain. The donor will then suffers a dry tax charge and pays the CGT, claiming business asset disposal relief if available. The trust might then have a small gain to pay when the shares are sold on the difference between the value at the date of the gift on the sale. And if the sale falls through, actually you can still claim holdover relief because you've got 4 years to be able to make that claim. So you've got some options there. There is also a third option in terms of if there is time and there is a family member who is employed in the business and they qualify under other categories, that the trustees can claim business asset disposal relief and hold a claim on the gift to the trust, but it's very infrequent that that's actually available. So whilst this session was a quick canter through the subject, and I appreciate that we're sort of getting very close to time, hopefully you will have an appreciation for the importance of planning ahead of time for the sale of the business and considering how best to protect and plan for the value being extracted. We've considered the availability of business relief and the factors that might restrict availability. By taking advice ahead of time, it's clear, I hope, that the position could be improved. We've looked at how we can use the valuable relief available to ring-fence assets for future generations in trust structures without triggering an immediate 20% inheritance tax charge. Often owners will transfer significant value into trust, and this can be a really good multi-generational estate planning tool. And for those who don't look at their planning before the sale or decide that they do not want to make a gift to trust, an alternative approach could be to use a family investment company. This is a subject on its own, and I don't have time to overview this planning today, but it is something that the team can pick up with moving forward. So looking at questions, I can see we've got quite a lot of questions coming up on the screen. And as I said, if I don't answer them now, I'll try and come back on this. There's one here asking if there would be stamp duty payable on transferring the shares into a trust pre-sale. The answer is no, because it's for no consideration. So that isn't an issue. We've got another one here. If there's a concern about the availability of business relief due to excess cash, can anything be done about it? Yes is the answer. So you can apply for advance clearance to HMRC if you're concerned about the availability of business relief, but also you can consider, depending on how much excess cash you've got, whether you could do something with that money in terms of investments, because as I mentioned before, as long as you don't become an investment business and you're still wholly or mainly trading, then having some investments could be the way to do something with that cash, and that's something to talk about with your advisors in terms of what you might look at doing there. I've got another one here. This is the $64,000 question. Do we think that there's likely to be a change in business relief or abolishment of inheritance tax? So I'm obviously talking about this dangerously close to a budget. I think we'd be amazed if inheritance tax was got rid of altogether. And I think the view is that if it was abolished by this government, on the basis that we may well have a different government next year, it would probably come back. I think there is some serious consideration over business relief in the context of the extent to which it's available. And I think our house view is that it may well be restricted on, say, AIM type investments, but we don't see that it being an issue for businesses. But unfortunately, I don't have a crystal ball, so that's a difficult one to answer. And I think time for just one more quickly before we have to finish up. What's the ideal timing to implement the planning? So in an ideal world, we would be looking at this ahead of time, even if it is just to get the trust structure and the advice and the concept all set up. We can drop the actual number of shares into the trust right up till there is a binding contract for sale, so pretty much up to the end. But trying to get people to really focus on this and think about it when they're also in the middle of a deal can be really difficult. So, the answer is we can do it really close to the deal, a few weeks out. But the ideal is that we do the planning and the advice as early as possible, and then decide on the number of shares when we actually know the value, because that's going to drive a lot of this moving forward. I'm conscious that I'm a minute over. Thank you so much, everybody, for joining this morning. As I said, I will come back to any questions that I haven't answered before, and I hope you all enjoy the rest of your day. So thank you.